According to the latest statistics from the Institute of International Finance, or IIF, investors have been pulling capital out of China at an unprecedented pace since the war in Ukraine broke out. It represents a highly unusual shift of capital flows in global emerging markets. Overseas investors are concerned that US and EU sanctions against Russia may somehow spill over to mainland China. IIF reports foreign capital is exiting mainland China on a large scale. A report by the IIF on March 24th shows a massive outflow of capital from the mainland stock and bond markets. At the same time, the flow of capital to other emerging markets remained unchanged. The Wall Street Journal also reported that in March and as of March 24th, foreign investors had sold a net $9.5 billion in Chinese stocks through the Shanghai Hong Kong Stock Connect and Shenzhen Hong Kong Stock Connect. Both stock connects are securities trading programs developed by Hong Kong exchanges. These outflows could be the second largest monthly drawdown since the program began in 2014. It reflects that international investors are reassessing the geopolitical risks following Russia's financial isolation. The largest monthly outflow occurred in March 2020 when the COVID-19 outbreak hit global markets and foreign investors sold a net $10.6 billion in Chinese stocks from mainland China. While analysts and investors consider it too early for a gradual withdrawal of foreign investment from China, they do agree that something may have changed after the recent market turmoil. The potential of Chinese companies being delisted from the US stock exchanges and the worsening outbreaks in China have also fueled the market volatility. Robin Brooks, IIF's chief economist, and his team wrote, "China's outflows are unprecedented in terms of size and intensity, particularly in that we haven't seen similar outflows from other emerging markets. The choice of capital to flow out of China in the wake of the Russia-Ukraine war suggests that foreign investors may be looking at China from a new perspective, although it is too early to draw any definitive conclusions in this regard." Brooks told the Wall Street Journal that Russia's invasion of Ukraine woke up foreign investors as many in the financial community didn't expect a war. He said Wall Street is now asking different questions about China than it was a few weeks ago. People are asking, why did we mess up investing in Russia so badly, and what else could we have gotten wrong? Brooks has been tracking international capital flows for a long time. He said, "I think China is the place where there could be a problem." Separately, Bloomberg reported that official data showed that foreign investors cut their holdings of mainland state bonds by the highest amount in February, in part because the Russia-Ukraine war prompted global fixed income investors to sell bonds. International sanctions imposed on Russia have led to the freezing of the Russian central bank's foreign exchange holdings in euros and US dollars. The public has speculated that Russia may sell its assets in mainland China to raise funds. Overseas investors are concerned that US and EU sanctions against Russia may somehow spill over to China. Investors are exiting Russian assets at an alarming rate after Russia's invasion of Ukraine. The financial magazine Barron said in a recently published analysis that Russia's surprise attack on Ukraine and the alarming pace at which investors are exiting Russian assets show the dangers of investing in an authoritarian country, especially one that is often embroiled in disputes over its borders. According to the Central News Agency in Taiwan, since Russia's invasion of Ukraine, multinational companies have been boycotting and withdrawing from the Russian market at an unprecedented speed. The Yale Leadership Institute categorized the global corporate boycott of Russia into 5 levels. As of March 24th, 169 multinational companies or institutions had withdrawn from Russia, 191 had suspended their operations in Russia, 30 had scaled back their operations, 56 had frozen new investments, and 36 companies were classified as having the lowest level of boycott. According to its analysis, part of the reason why so many multinational companies responded so quickly to the war against Ukraine is that the response to the war, which has been mobilized most fervently by global social media, is crucial to corporate brand image, and many CEOs of major companies have publicly pledged to fully commit to corporate social responsibility. Political similarities between Russia and China make investors nervous. Sanctions against Russia is a wake-up call for investing in China. The outflow of capital was most severe on March 14th and 15th as China's onshore and offshore stocks plunged. The Communist Party's top brass stepped in on March 16th to reassure investors, and the 2 days that followed were accompanied by a strong capital injection. Then more moderate capital outflows resumed. Despite it, the Wall Street Journal said a pullback in March would be a rarity. According to Wind Data, foreign investors have been net buyers in about 5 out of every 6 months since Hong Kong's Stock Connect program began, with outflows rarely exceeding $3 billion in other months. Even in 2021, when Beijing clamped down on tech companies, foreign buyers continued to buy stocks during the period. While dealing with this immediate problem in Russia, international investors are also looking at China. Like Russia, China, under the Communist Party, is an authoritarian state that has been criticized for human rights abuses and its blatant disregard for environmental protection. Corporate policymakers and experts are beginning to explore how to respond to the next possible major flight of capital, an exit from mainland China. The turning point, they predict, will be a military invasion of Taiwan. However, given that the Communist Party has always cited economic growth as one of its proudest achievements, it is hard to imagine that China's chairman, Xi Jinping, would risk exposing the country to devastating economic sanctions by invading Taiwan anytime soon. The commentarian Barron argued that China is not Russia. The former is far more integrated into the global economy and has a far larger market. But the Russian maelstrom has important lessons for investors in China, both as it relates to the war in Ukraine and for how to manage the risk of a widespread decoupling brought on by growing tensions and a major confrontation, including over any future Chinese invasion of Taiwan. The head of a Japanese asset management firm told Japanese media, the Nikkei, "If such an invasion were to occur, we would have to review our investments. But would we be able to make such a decision? Honestly, I can't say." His view is widely shared by the industry. Jim McCafferty, co-head of Asia-Pacific Equity Research at Nomura Securities, said many fund managers focused on emerging market investments were told by fund investors to get out of Russia after the Russian invasion of Ukraine. He said some of those asset owners also decided to exit China given that the two countries share some political similarities. Some analysts suggest that foreign money used to flood the Chinese bond market for a long time, and if foreign financial investment now starts to dry up or flow out of China, that would remove support for the yuan's exchange rate, which has been supported by capital inflows and a surge in Chinese exports. In January, the additional yield on Chinese sovereign debt relative to U.S. Treasuries fell below 1 percentage point for the first time in nearly 3 years, reducing its relative attractiveness to investors. In February, foreign investors sold the equivalent of $5.6 billion in yuan-denominated government bonds, setting a record for monthly outflows. As noted earlier, foreign investors have exited about $9.5 billion of stock investments in mainland China so far in March. Although compared to the total value of the Shanghai and Shenzhen stock markets of about $13 trillion, the size of the foreign sell-off in March is relatively small.